One of the most overlooked aspects of retirement planning is tax planning. And tax planning is so important because let's say you have $1 million portfolio. Well, after taxes, that could end up being $800,000 as an example. So $200,000. So before you retire, you need to consider some strategies, and I have 6 that I want to share with you. 6 strategies that you can use to reduce the amount of taxes you'll pay in retirement and put more money in your pocket. That's what it's all about. Strategy number 1 is Roth withdrawals. So if you open a Roth IRA account, you can take those withdrawals in retirement tax-free. So if you don't have a Roth, it's probably a good idea to set one up. There's a 5-year look back. So you need to keep your money in there for 5 years before you can start withdrawing. And you need to pay attention to the contribution limits. Number 2 is an inheritance. Now, you won't pay taxes on an inheritance, but it's probably not the best idea to depend on an inheritance for your retirement plan. But it is expected that women are going to inherit a very large sum of money over the next decade as baby boomers transfer their assets, and women are going to be primary beneficiaries of those inheritances. So it is definitely something to consider, although you shouldn't depend upon it because you never know. Municipal bond income is number 3, and those are issued by states, cities, and local municipalities, and those are a source of tax-free income because the state in which you reside typically says that those are exempt from state taxes. Next up is life insurance proceeds. So yes, any of those proceeds from a life insurance policy are tax-free. A popular one to check out is an index universal life policy, and they provide numerous other benefits in addition to being tax-free. And number 5 are HSA withdrawals, or health savings account withdrawals, not to be confused with flexible spending accounts. An HSA is triple tax-free, meaning there is a tax deduction when you contribute, they grow tax-free, and you can take the money from an HSA tax-free. Pay attention to the contribution limits, but they are a great tax-free source of money to fund your healthcare expenses in retirement. And as a side note, you can use proceeds from an HSA for non-medical expenses. However, you will pay taxes, but you won't pay a penalty. And then finally, Social Security. Yes, over certain limits, Social Security is taxed, but under certain limits, Social Security is not taxed. And as a side note on Social Security taxation, you will be taxed if you're an individual making more than $25,000, or if you're a married couple filing jointly making more than $32,000. And there's one bonus way to have tax-free income in retirement, and that is through a reverse mortgage. Yes, you can take out a home equity conversion mortgage, or what is called a reverse mortgage, and the proceeds from that mortgage are tax-free. This is a great way to use the housing wealth that you have, leverage that debt asset, and create a tax-free income in retirement. Reach out to me for more information and education on any of these tax-free income sources in retirement. Let's get her done.